And good morning, good morning, good morning. Welcome. We are officially live broadcasting from Rhode Island right now. This is Money Matters. My name is Nev, and today we're going to be taking a look at a little bit of what's going on in the news. Of course, we're going to take a little bit of a look in the crypto, but we're going to be focusing predominantly on the markets and economy as a whole today because we have some important news that I think everybody should be paying attention to, and that is the whole talk about the dollar versus Bitcoin versus gold versus are they printing, are they not? What's happening with the stimulus? Is it coming? Is it not? Are you going to get anything? Are you not going to get anything? So we do have quite a bit of stuff to cover today, and I do want to welcome everybody who is watching this live and everybody who is, of course, watching a replay or listening to this to on one of the podcasting services. If you're brand new to the channel, hey, do me a huge favor, smash the subscribe button right about now. If there's some sort of notification, you might want to hit that as well. And if you like the show and there's a like button, thumbs up button, check button, heart button, hey, smash the button. All right, y'all, let's do this. And good morning. Happy Monday to you. Yes, it's Monday. Can you believe it? We're only a few weeks away from 2021. I know many of you are very, very excited, and I don't know that there's going to be many people out there in the world that are going to cry over 2020 being gone. It's definitely been a very challenging year for most of us. Some of us have, of course, done really, really well, but overall, as individuals, as species, I think we have suffered quite a bit over this year. And I know there's going to be many people that are excited to say, you know what, let's just call it the end, call it quits, and let's move on. But before we move on, we still have a few weeks left. So what is happening? Well, is the stimulus coming? Yes, there is going to be news. I believe we were told that it's going to be released later on today. So on Monday, this weekend, I guess the Congress people have been working on a new stimulus deal that is going to be rolling out, and it's going to be way smaller than anything else before talked about. Remember back in like March and April, there was like trillions of dollars and stuff, and then since July, they've been going back and forth, couldn't agree on anything. Right now, because so many things are set to expire basically in a few short weeks, while many of us might be excited about 2021 coming in, there's also many more individuals that are also petrified of December 31st because so many things actually expire. So the government has gotten together finally, and they have a bipartisan deal of about 908 billion, so way shy of that 2.2 trillion, 3 trillion that they have been talking about. And in this particular bill, not much has been released of what's going to be in it. One thing they did say is they're not going to be sending money to the individuals. So if you were hoping or planning that you're going to receive, this cash check or a direct payment of some sort, that is not coming in whatsoever. So that's one thing for you to know. Now, other things that we want to also talk about is found in Cointelegraph, and it talks about the news of the U.S. stimulus, Brexit, and kind of things to watch out for in this particular week. And of course, we know that we've printing $7 trillion in money printing is what they're proposing, right? So you do know that a new president, I guess it's been decided on. I have no clue. It's still sort of like, yes, it's on. No, it's not. Plan for it, but don't expect it. So nobody really knows. I guess we're just going to have to wait till January 20th and see what happens, right? But right now, it's looking like more likely than not that Biden will be inaugurated on January 20th, and he is already stating that he plans a $7 trillion recovery package to tackle the impact of the coronavirus. Now, this is very exciting and kind of cool, and the reason for the excitement and the cool piece about the whole thing is because, well, more money is going to be coming in to different businesses and legislations and that kind of stuff. Will we see any of that stuff? Maybe, maybe not. There is a big problem though that you are printing way more money and creating additional debt, meaning that we're pulling the productivity from tomorrow into today, which helps today, but it leaves a giant gap for tomorrow. So that's one of the things that is very interesting. And the other piece is that, well, this additional printing could potentially weaken a dollar even further. And if that is the case, well, that of course opens up the case for certain other investments to be held as a store of money. Of course, Bitcoin could be one of those things. Many people are saying gold could potentially be one of those things as well. However, we are seeing something very, very interesting. While the dollar is falling, the gold has been falling as well. This is not typical and it's not normal. Typically, when the dollar goes down, gold goes up, and vice versa. Right now, we're actually seeing both gold and the dollar going down, and Bitcoin, of course, has gone up, and it's now consolidating into this beautiful triangle pattern that I'm going to show you right now. So yesterday, when we were chatting and discussing certain things, we saw this green triangle pattern that I drew. Of course, since then, some time has passed, and we're seeing something different that is developing, and that is this sort of fuchsia colored triangle pattern that is re-emerging from it. As you can see, we did break above this green triangle zone and have kind of come up even higher, and this has allowed us to create a brand new triangle over here that right now we have been kind of going up. We did hit the top twice. Now we're actually contending with the bottom piece, and if we actually zoom in, which I'm about to do right over here, you can see that we actually broke below it, and now this triangle pattern that was previously the green triangle pattern that was previously sort of the top, it looks like it's becoming the support line. Again, don't know exactly how this is going to play out, but what we do know is that typically, not always, but typically, vast majority of the time, when we do have these triangles, and now we're having a double triangle, that means that we can expect to see an even higher, even more volatile, let's put it that way, even more pronounced movement to the either upside or the downside. And this was basically a symmetric triangle right over here that could have gone up or down. This seems to be an ascending triangle right now. So that tends to be a movement on the upside of the whole thing. So that's something to kind of think through and consider. So right now, I know many people are like wondering what is going to happen. Is it going to go up? Is it going to go down? I think it's going to go still a little bit of sideways, but I think it has a very strong potential to hit on the upside and break over not just 19.5 or 19.9. I think it has the potential to break over $20,000 for this time around. So we'll see if that's going to happen. Again, we are guessing at the best. Now, one of the other things that we also know is that Biden did choose Janet Yellen as the next Secretary of the Treasury. One thing that we know about Janet Yellen is that she does enjoy spending and printing money. So that could be very bullish for Bitcoin, especially long term. And I think it could be also very bullish for gold, even though gold hasn't been doing much of anything. But we do have some opposing news because I think, while it's kind of lovely to hear the same rhetoric over and over and over again of how, like your beliefs are being supported and you are right, I think it's important to look at both sides of the spectrum to make a decision of what does make sense. Because when you get stuck into your head that you are right and everything else is wrong, that's the part where things could be very, very and highly problematic. Now, of course, Cointelegraph did report that the strength of the dollar is predicted to fall further in 2021, and there's some of the other analysts that are predicting that as well. But again, we do have some opposing news that we're going to be taking a look in a few moments. Now, one of the things that also Preston Bush has noted is the opposing direction of the U.S. debt versus the M2 money velocity. As you know, that when they create money, they basically create M2, right? Which is M0, M1, and M2, and they don't print anymore the other stuff. They just focus on M2, and that's this money creation, this debt creation. If you remember, money is debt, which I know it's very confusing. You're like, wait a minute, I have a wallet full of debts. Yes, you do. Yes, you do. And liabilities as well. So, of course, one of the things that as they create these stimulus, as they actually get in these assets and everything else, the money supply ends up growing. This debt ends up growing. Typically, in order to move the inflation any which way, the money velocity has to keep on moving. Money velocity basically means that, I take my dollar, I give it to you for your good and service. You take that dollar, you give it over to the gas station. Gas station person goes and buys the shoes for the kid. The shoe store owner, you see kind of where it goes, right? That's the money velocity. And money velocity actually has been going down as the printing has been going up, which is a very, very weird thing. Growth in M2 money supply is up 22.5%. However, velocity of money is down by 20%. So it's almost there. They're offsetting each other, right? They're offsetting each other, and that's why we're not necessarily seeing as much of the movement. Now, one of the things that the reasons, this is not part of the article over here, but one of the reasons that I believe that we're not seeing as much of the money velocity is because when the Fed creates this sort of like QE, right? They basically put in and shift how the bank's balance sheets and reserves are being looked at and considered. And now it's up to the banks to basically look at the backing from the Fed and say, yes, we are going to go and lend money. The problem is they're not lending. Yes, we've seen lending for the homes. Yes, we've seen the margin trading go up. But the lending as a whole, right, like the private loans into small businesses and that kind of stuff, that actually has fallen, and more small businesses are having much harder time borrowing money. And you've likely seen the news, we've covered part of it over here as well, that, when there was this giant stimulus of money going to the businesses, well, that actually has transpired that it went to the large businesses, and the small business, minority held businesses are the ones who basically got almost nothing. And that's kind of what we're seeing, more and more of that. And I do expect that we're going to be seeing even more businesses shutting down over the upcoming weeks and months. And it's going to be a really rough winter, economically speaking, I believe. Weather-wise, I got nothing. The stimulus coming, but without checks, and of course we just talked about that stuff, and the stimulus package could appear as soon as Monday, so today, and but there won't be any stimulus checks coming in. Now, the UK is meeting with Brexit Waterloo. It's make or break for the United Kingdom and the European Union agreeing on the Brexit trade deal. Sides now accepting the time has run out, and of course the pound has been suppressed as of Monday as uncertainty took the hold, and if the surprise lack of trade deal would automatically shave off more of its value, which is what is coming from the analysts, and we are expecting to potentially maybe possibly see some additional buyers coming in from the UK to get into the Bitcoin. Of course, the final piece that is also very positive for Bitcoin, which I think everybody already knows, we've been talking about it here as well, is the fear of missing out from the institutional investors. We still have vast majority of investors are retail. However, the amount of holding that each institutional investor has is much larger, and that money tends to be stickier. And we do believe, or the analysts believe, that there will be more of those dollars or yen or pounds actually even coming into the market, pushing Bitcoin higher. The other piece that is very interesting and exciting for the blockchain community as a whole is that Thai tax collection is going to streamline revenues with blockchain technology in 2021. Their collection agency will be utilizing the blockchain, and their excise department will be improving how they're collecting the revenue in lieu of actually raising the taxes. So they're saying we're not going to raise the taxes this time around. What we want to do is we want to actually just improve how we collect our tax, how we collect the money, so that we get more of it without having to raise the taxes on everybody. And so they are right now leveraging this piece. They've been utilizing blockchain technology for a little while, and now they're going to connect multiple different departments within the government to improve upon this. So this is an exciting piece. I also did read somewhere that there's another government that I want to say maybe Germany. I'd be wrong. Don't quote me on that, please. But there's another government that local government that is going to be testing blockchain for voting. So I know that that was a hot topic here in the United States of how are people going to vote, and many people in the blockchain community were saying you just got to use blockchain. And so now we have officially one of the local governments that is going to be using blockchain for their voting services. Okay, so I did promise that we're going to take a look at a different kind of article that is not necessarily all that bullish, and it's given us an opposite view of the views that many of us might hold. And you might have some of the other things as well that are part of it. Now, one of the start of the article is that many people are very bullish on the stock market, and people have been jumping into it. This over here, for those of you that are watching, you can see a chart of S&P 500, and you can see that this was February over here where we kind of hit the high. Then we came down super low in throughout the March, and into April we started to do a nice recovery, coming up much higher and likely closing the year much higher than we were in February, with many people reporting ridiculous gains. However, they are arguing that there is a lot of group think happening. Currently, the markets is extremely one-sided as investors chase markets. As noted yesterday by the author, the number of stocks above their 200 daily moving average is at the highest level seen in several years. Such is not healthy, and previous peaks have consistently preceded unexpected declines. Of course, you can see the chart over here. Again, it's the S&P 500. It's a much longer chart that takes us back into the 16, and it kind of shows every time that we've been sort of this one-sided, how there is a correction. Now, sometimes that correction, as we can see in the 16 and 17, is not as high. It's a correction, but it's a small correction. And then at other times, like for example in 2018 or even in 2020, that correction is much, much deeper and steeper. So that's something to kind of pay attention to. One of the other pieces that I also do want to point out when looking in this particular chart is that typically the deeper sort of downfalls have been when the market actually has a steeper moving on up, which again is very normal. And you can see that we've had a very steep move on up, which is why he's arguing that we might be at the precipice of potential immediate crash coming our way. Fear and greed ebb and flow. Fear prevalent in March has been replaced with greed in November. Now, of course, we might also remember that crowds are wrong at peaks and throws. So, of course, everybody is optimistic when everybody's optimistic, and everybody's pessimistic when everybody's pessimistic. And that's sort of the crowd psychology of the market, of the people. As we look out beyond this year and into 21-22, profit and economic expectations seem too optimistic as a number of small and large businesses have been gutted by COVID-19. And of course, everywhere there was a sign, it would be quite lovely. But they're saying there are some signs that we should be paying attention to. For the first time in 15 years, 60% of the indicators we track are showing an excessive amount of optimism, an excess of excesses. And typically when we see an excessive amount of optimism, there is a room or a potential that things would kind of collapse. It's sort of like how the markets play, right? When things are really down, everybody is fearful. Very few and very brave step into the markets and start potentially buying, seeing what's around the corner. As those markets keep on going up, people get more optimistic, saying, well, it's been going up, it's likely going to go up, I should probably jump in. As more people start jumping in, of course, the prices start coming and going even higher. We've seen this many, many times happening over and over and over again. And of course, now there's a belief that Fed has our back, right? And they will not let the market crash. But the unfortunate piece is they don't control the markets, okay? It's only people and the investors in the markets that control it. The bullish sentiment can and often does carry markets further than logic would predict. However, without exception, when everyone is on the same side of the boat, a reversion will occur. The speculative call option buying is at the record level, not risk level, is at the record level, while put buying, which is a hedge against the downside risk, is basically non-existent. Now, if you're trading options, you know that the call option is basically buying an option when you expect that a particular market or particular stock is going to go on up, and you look to buy it at a lower level so that when it goes up, you're actually making money. The put side of the things is when you're like, I kind of think it could go down, so you either buy it to benefit from the market going down, or if you have a strong position on the bull side, on the upside of the market, you buy some puts as a hedge in case things go down, that you're protected and you don't lose as much money. But now they're saying, well, the put, meaning that people are sort of worried and want to protect themselves, is non-existent. And of course, you can see the U.S. total call option volume 20-day moving average. As you can see, that while we have entered basically the depression, recession, however you want to call it, that things have been going on up. And we are seeing that the U.S. put call ratio is, basically down to 0.6. So it's very, very low. History shows that such extremes have led to short-term corrections or worse. All that is needed is a catalyst to start the selling, and once that happens, of course, well, you kind of move on up. The volatility signal. In a market that reaches a point of more extreme complacency, it is not surprising to see volatility drop to lower levels. The volatility index, VIX, has basically reached the bottom, where previous mark peaks formed. However, just because a certain level gets reached, it doesn't mean a correction is immediate. Often lower levels remain for some time, but when a buy signal is triggered, a volatility then turns upward, and it turns upward very quickly. And then again, we can see the chart of the VIX, how it was basically super low in 2019, and then what happened? As we sort of reached this bottom, the market reached its top. As the market went down, the volatility just spiked up through the roof. And of course, as the market started to recover, volatility started to slowly keep on going down. And right now, well, we're not at the same level that we were back in February of 2020. We are approaching that level very rapidly. With the market currently pushing a 3 standard deviation extreme from the 50-day moving average, the stage is set for a short-term correction. That deviation, combined with the negatively divergent RSI and more than 90% of stock above the 200 daily moving average, is a warning. As the vertical lines show, the combination of these measures has previously aligned with market peaks. And if we look at this stuff, you can see the RSI is here at the top of the chart. This, of course, is the S&P 500 market. You can see kind of where it's been going on up. You can see that the RSI is actually, while it is kind of going up and down, it is we're seeing the lower highs within the RSI, which is a signal that markets could potentially overturn. You combine that with the 200 daily moving average, vast majority of the stocks being above it, and the super low VIX, and now you have a potential recipe for markets to turn downwards, and that is what they're arguing. Given the rather sharp economic recovery seen in the third quarter, the stimulus input will have a more muted impact on future activity because they're arguing that's already been priced in to everything else. Also, given this bill does not have a direct check to the household, just like we talked about, the boost to consumption will be way less. I actually say the boost to consumption will be basically zero. Since consumers have been locked down due to the pandemic, there's a vast amount of pent up demand in the system. As soon as consumers are unleashed, they will rush into the economy and spend with reckless abandon. However, in this cycle, the excess unemployment payments and direct checks to households led to a spending spree in houses, automobiles, and various services. We're going to pause over here for just a moment before we continue with the article. And one of the things that is also interesting to point out is that we did receive that additional payment to, well, not everybody, but a lot of people have received the additional payment. So there was a extra unemployment piece, there was checks to everybody, there was all kinds of things that were happening. And of course, why did third quarter boom on up? Well, it's very simple, right? Because in the second quarter, many of us were still locked down, right? The first quarter was January, February, March, right? Like that's when the whole shutdown happened. Then we were kind of like locked up. That's when the stimulus kind of started to happen. While many people were using their money to pay off their debt, they were waiting for nice weather and to be let out. So when they let us all out, that's when we actually started to go in, we started to shop, we started to do all these different things. And that's why in the third quarter they were reporting all these different gains. So remember, everything is a laggard. Everything that we have here that is a true sort of analysis piece of knowing what's going on is what actually happened. Nobody has a crystal ball to tell you exactly how things are going to happen tomorrow. We just know tomorrow will come and something will happen, but we don't know exactly what, right? So that's why we're seeing some of the stuff. But unfortunately or fortunately, because the economists are looking at the laggards, they're looking and seeing and saying, well, the economy was doing really well in the third quarter, of course, because everything was being reported as awesome. We know that that's no longer the case because we're living through it right now. But they're looking at the data and saying, well, we don't need to do extra money because, everything else has happened. So we're going to do a little bit just to kind of tie people over and just sort of like, pat it up and call it a day. So that's kind of where we are and what's happening. Now, what they're saying is that there's likely not as much pent up demand coming in, and I agree. Black Friday in store sales was down 54.5% year over year. That's a huge drop. But of course, the Bubble Vision wants to talk about how online was up 21.5%. Total consumer spend last holiday season was $730.7 billion. Online was only a little over 100 billion. The 21.5% increase in online is insignificant because if you take the 55% from the 730, right, and 21% on the 100, you can actually see that there's not much that was, as exciting as it was that the online went up. It didn't. People weren't shopping as a whole. So, of course, they are also arguing about the portfolio and their positioning and their update. And I think that there's some really interesting components that perhaps could serve everybody here who is watching and listening to the show today. It is at these points in the market where investing seems like can't lose opportunity that risk tends to present itself in the most unruly of fashions. And I think this goes for traditional markets. I think it also goes for the not traditional markets. Every time you go into the frenzy and allow your emotions to take over your buying or selling decisions, you are likely making a wrong call. That is why all of the investors and traders always have these very specific rules that they follow, that they have created outside of the emotional market, outside of the money going in and out, and they are using this stuff to actually help them when they get into the emotional situations to then make a decision of what does or doesn't make sense to do. We are carrying higher levels of cash than usual, and this is not unlike many other people. Many people are using the cash levels and carrying them, at a much higher levels. And some of the folks that are not using cash, they're actually using certain treasuries like gold and Bitcoin. However, do keep in mind that these can be volatile, not as much. One is much more volatile than the other, right? Gold is much less volatile than Bitcoin, but Bitcoin does have a much higher potential to move on higher up and give a great return on investment. So many investors are putting in their cash. Of course, they have some cash, but they're also putting in substantial amounts of their treasuries into assets that potentially could protect their wealth. We are watching the US dollar very closely. It is now extremely oversold with a large net short position. Such is a prime setup for a rather sharp reversal, which would lead to a lower prices in commodities, stocks, emerging markets, international markets, and Bitcoin. So that is something to also be very, very careful and cautious about, because as I have mentioned, many people are going to go in and put their money into different assets, but they're saying, well, if the dollar actually has reached its bottom and now it's going to go on up and go higher, this can be highly problematic for many different things. Now, one of the things that you also might know is that the President Trump for the last 4 years has been saying and calling for wanting dollar to be lower, dollar to be lower. Well, he finally got that. And the reason he wanted that is because, well, he wanted to make sure that we do receive higher sort of exporting stuff, right? So that more countries would actually want to import the goods from the United States. And there are charts that you can actually find on your own from Fred that show that we're not seeing quite that. We've seen a little bit of an uptick, but not by much. That is also another sign, and I think part of it has to do with just something weird is happening in the economy as a whole, because we have too much evidence of it, right? We are in the biggest sort of recession, depression even, than we have been in over 100 years, right? And but the markets are going on up. That doesn't make sense. Dollar is going down. That doesn't make sense. Gold is going down together with dollar. That doesn't make sense. And even though the dollar is cheap, there's not much monetary velocity, even though we have way more M2. And on top of that, the exports slash imports, depending on who you are as a country, but U.S. speaking, exports are not going on up. Now, I think that part of the exports not going on up is because the consumption as a whole, trade as a whole, is actually slowing down globally, and it has been slowing down for years because of the aging population around the world, and we were basically going to see this anyways. What has sped up is COVID, right? COVID has sped up this whole thing. Now, additional piece that I also think it's very important to understand is that many individuals, especially in the United States, we're talking tens of millions of individuals, are baby boomers. And baby boomers, well, they are retiring. And many of them are in these retirement funds that have this whole like stock portfolio, right? Like the bond stock ratio that have entered sort of the based off of the year in which they are going to retire, and those are set to rebalance, meaning that as they age, the amount of equity in the portfolio drops and the amount of bonds actually goes up. And we're seeing this drastic sort of move and shift in when more of the individuals actually get out of the stocks through their retirement plans that they have set up and put on autopilot. That also could trigger another major sell-off in the stock market. Again, is it going to happen? Is it not going to happen? Sure. Market downfall is going to come. Is it going to come today or next week? I honestly don't know. Typically, not always, but typically, December tends to be a good month for equities and for investors. However, January is known to bring on some pain. So there you go. You have been duly warned. Make sure you pay attention to your portfolio. Do risk management. If you've made some money, it might not be the worst idea on the planet. Again, not a financial advice. Nothing I say is, but it might not be a worst idea on the planet to take a little bit of your money take a little bit of risk, put it in some cash position, let the rest of it ride. And my way of kind of looking and doing this stuff is, when I would go and invest, and what I might do is just take off, especially if it has appreciated to such a level where I can do that, is I would take my initial investment out and then let everything else ride. That way, basically, whatever return I get is infinite return on investment because I have zero of my own money left into this investment. I hope this was helpful to you. If you have enjoyed the show, hey, do let me know by, hey, going into the chat and letting me know. Smash the like button. And if you subscribe and put notifications, I will definitely see you tomorrow. Until then, stay forever money blessed. And do remember, you are only one